Hi, welcome to the quarterly market update for the final quarter of 2025. My name is Hugo Good and I'm joined by Investment Director Andrew Garrett.
Hi.
Andrew, 3 years now of this bull market, and MSCI All Country World Index and the ASX 300 have posted for the third year in a row double-digit returns, albeit this year was probably the most muted out of the last 3 years. How did the quarter finish up for the final quarter of 2025? And what were the key themes that drove markets?
Thank you, Hugo, and thank you for being in Melbourne. The year as a whole was quite an interesting year. We came into the year expecting a little bit of turmoil from the incoming Trump administration, and we got some. Obviously we saw the sort of sell-off in April after Trump had his Liberation Day tariff announcement, as people really started to realise that his bark wasn't necessarily worse than his bite, that his bite was going to be equally bad, and that this Trump administration was certainly going to be far more assertive than the first Trump administration. And certainly the time that he spent in the wilderness in between the two presidencies, he's spent a lot of time thinking about what he could have done better from the last time. So a lot of disruption throughout the year. We've seen pretty volatile markets, but we've seen strong returns over the whole year. Admittedly, your question was really about the final quarter. The final quarter was a bit soft. However, that was a soft quarter that just finished off a really strong year. And when you think about it, the seasonality that we tend to see, where you see a bit of a Santa Claus rally closing off the end of the year, we didn't get, nor did we get the softness that you typically see around August and September, the so-called September effect. So all in all, a strong year as markets were able to shrug off the noise and really focus on some of the thematics like AI, but also the simple facts that unemployment across most of the world is still very low, and that the consumer remains pretty strong.
You touched on AI. It's been a hot thematic for some time now. We go back to November of 2022. That's when ChatGPT launched, and I feel like it's just dominated headlines, investment markets, and everything in between. But how do we see that thematic playing out in 2026? And do we see any changes in how investors are going to look at AI, the AI developers, or potentially the AI beneficiaries who don't make the models, but certainly are going to hopefully see those productivity gains?
You mentioned that ChatGPT was launched in November 2022, but it really only sort of came to the fore of the public's consciousness in about February 2023. And the sentiment impact that AI has had on markets, I mean, if you sort of play that thought experiment of removing the benefits of AI or the AI thematic from markets, there's a lot less to be hopeful for about the economic position and the outlook. So the emergence of AI has been really strong for markets and strong for investments. It's fueled a lot of spending. You've got OpenAI, for instance. I think it is committed to over $1 trillion worth of spending on data centers. I mean, they don't have $1 trillion, by the way, so that's an interesting conundrum. But AI has definitely propelled markets forward and given something for investors to hope for. I think what remains to be seen is how much it's actually benefiting companies and consumers. And we are starting to see a little bit of a slowing in uptake of AI usage, and some people, apart from cute cat videos and things like that, it's less certain about what benefits it's actually bringing. So look, at the moment, the AI thematic remains intact, but it's one to watch. There's a lot of exposure, particularly given how big that sector has become. There's a lot of exposure in markets to AI, and it's a matter of seeing what plays out next. I think the real fear would be that we see one or more of the big sort of mega companies start to rein in investment on AI. I think that would send tremors through the market, but we're not seeing that yet, and I think there's a lot of momentum behind what we're seeing with AI.
It's interesting, the Magnificent Seven, I think, over the last 3 years has done, 325% cumulatively. MSCI All Country World Index has done about 80%, and the ASX 300 just a bit over 40%. So some big divergence between the numbers there, and AI has certainly been a strong contributor to markets for the last 3 years, but remains to be seen whether it will continue to contribute as much as it has going forward.
And the other thing to bear in mind is it's not really generating profits yet, right? So it's definitely one to watch. You don't want to get in the way of this thematic because there is a lot of power, there is a lot of consensus thinking behind that. But we do expect that thematic will soften over time. It's hard to see whether, basically it needs to deliver some pretty big productivity improvements to justify the spending that's going on.
And moving on to inflation, obviously Australia's had a few hot inflation prints over the last couple of months. It does seem like the RBA is probably looking like they'll hike in 2026, whereas the US Federal Reserve is more concerned about the slowing labour market over there and looking like they'll cut. What's our view on the path of rates going forward and inflation more broadly?
It's interesting because more generally since the GFC, but also more recently since the pandemic, most major central banks have been in lockstep. They've all either been increasing rates to combat inflation or reducing them to support economies. This is the most divergence we've seen across central bank intentions for quite some time. And that will invariably have an impact on currencies. Look, I think we've been talking about higher for longer, about interest rates and inflation for 3 or 4 years now. It's been a sort of battle cry of ours, and that remains intact. The idea that inflation was going to disappear just as quickly as it arose, particularly in an environment where you've got a strong consumer, where you've got very low unemployment, even if employment has softened a little bit, it's still very low against historic standards. So, I guess for us, we're paying very close attention because those currency impacts, we haven't seen much FX volatility until last year. And last year we saw the US dollar weaken by about, I think, 12% over the year, which is quite strong. The US dollar has been the gold-plated, central bank currency reserve that's been available for a long time, and that's fading. And so looking forward, I think paying attention to the intentions of those central banks. And you mentioned that the Fed's sort of more worried about the labour markets, but also there's a lot of political pressure on the Fed to get more dovish as well, with a certain US president really putting a lot of pressure on. And he's just about to pick it, whoever the next governor will be. So that will be an interesting thing to pay attention to as well.
Yeah, we'll get the quarterly CPI for the final quarter in Australia on January 28th, and that should provide some more clarity on the path of rates here in Australia, because the RBA has really not paid too much attention to those monthly figures, but more focus on the more reliable quarterly figures. We've spoken a bit about currency, but going back to interest rates, what does this all mean for income investors and investors who rely on that income?
The simple answer is income investors should continue to benefit. What's happened is we've seen interest rates come up and cash rates come up, and the entire yield curve shift up over the last few years. And anyone who's been invested in sort of long-term, whether it's bond funds or any sort of general exposure, will have had in that a lot of very low dividend or low coupon bonds in there that will have been phased out over time. And if you look at the yield of sort of the fixed income indices over time, you're seeing them gradually increase the income production as it catches up to where the current yield is. And so there's a bit of room for that to move. So the good news for income investors is, even if we do see cuts, in the US or here to the cash rate, if you're invested in fixed income, you're invested deeper into the curve. And so actually where they're invested is probably still going to benefit. And so it's nothing that we're worried about right now, but it's an interesting thing to pay attention to.
Changing gear a little bit now as well. Geopolitical risks and events have been a feature of 2025, and you could argue the last couple of years. Obviously, we had Liberation Day, we had the Middle East war and Russia and Ukraine continuing. There's about 60 world conflicts going on at the moment, which is the highest level since World War II. And then most recently, what's happened in Venezuela. Does 2026, pose more or less geopolitical risks? How are we thinking about that in terms of investment markets and how we're investing?
Geopolitical risk is sort of important, but not important at the same time for investing. Most geopolitical events are very short-lived by investment markets, whether that's, conflict in the Middle East, you see the oil price spike, but a couple of weeks later it's back down again. You see Russia going to Ukraine, same thing again. We see these geopolitical events. Everyone thinks, it's that Chicken Little effect, the sky is falling, but then, markets move on. And geopolitical risk doesn't tend to impact investments in the short term or after an initial sort of blip. That's changing, and what we've seen from the new Trump administration is really throwing away that cooperative type worldview where allies work together to keep out the bad actors, the authoritarians, etc., to an environment of might is right. If I'm the strong guy, if I've got a bigger military than you, then I get to say what I want. And that's sort of going back, Trump loves tariffs. Well, the last time tariffs were used heavily in the US was 100 years ago. And Trump also loves the sort of mercantilist type, 60-year-old view aligned with the Monroe Doctrine. And the Monroe Doctrine very much sort of focuses on the US being the master of its own domain, and its own domain being the Americas as a whole, and pretty much the rest of the world can fend for themselves, and that they'll sort of do what they want in the rest of the world, but everyone should leave them to their continent. The fact that we switch from a cooperative world to a competitive world means that, if anything, the geopolitical noise is going to stay at the same level or go higher.
I'm reading that it's now being called the Donroe Doctrine. The Donald obviously wants to insert his name in a lot of things, so that's something quite interesting.
It absolutely is. I mean, he's added his name to quite a few things recently.
Thanks, Andrew, for joining me today. And thank you for tuning in. If you've enjoyed what we've talked about, please do read the report that delves into what went on in Q4 as well as our outlook. Thanks for tuning in, and we'll catch you next time.